You're watching Personal Finance with Coach Kelvin. Let's get into the video.
Hey guys, Coach Kelvin here, and today I want to talk to you about basically the three most common places to build wealth as of 2022. So basically, outside of sort of building your own business and creating a wealth asset or income stream through building a business and having products or services to sell, as this requires work, there is a few other places you can park your money and you can expect a reasonable amount of return in order to grow your wealth. So I'm going to talk about three asset classes: property, shares, and then cryptocurrency. But we'll focus on Bitcoin as the main crypto because it has the longest track record to sort of go by. So, especially here in Australia, property is sort of the darling investment that everybody refers to or knows about. So when it comes to looking to increase your money, the sort of narrative that is told by our parents, by our friends, or random people at a barbecue, etc., is that every 7 to 10 years your value of your property should double. You're looking to achieve about 7 to 8% returns on that property every single year, and over the long term, you're likely to really, increase your net worth, because as the value of that property goes up, you're generally paying down a mortgage, so your liability becomes less as your net worth increases. Now, the Australian dream is basically to own as many properties as possible, earn rental income on them, and negative gear everything so that you can, have a tax return at the end of the financial year. Now, my frustration personally with negative gearing, and both of my properties were previously negatively geared due to having a smaller income than what the liability of the mortgage cost, is my biggest problem with it is that for 11 months of the year, you're essentially struggling paying out that shortfall in whatever the rent does not achieve in order to then increase, your property portfolio. So you keep negative gearing all these properties, reducing your cash flow because you're paying out money out of your take-home wage every single month in order to make up that shortfall. So it actually becomes more and more stressful the more down this path you go. And that's why I think, regardless of looking for the tax write-off of a property, it makes more sense to go for a positively geared property where you'll just earn more income off that property. Obviously, you'll have certain tax advantages from that property regardless of earning a higher income rate. But at least when it comes to trying to have high cash flow so that your general day-to-day life is not stressful, it will be there. So for example, if your liability on your mortgage was $2,000 a month and you were earning $1,500 in rent, after you have paid your property management fees, any insurances, any other maintenance issues, let's just assume you're earning about $1,300 a month. Now you have to make up a month $700 just to cover that shortfall in what the rent is to cover that gap in the mortgage. So you're going to be placing a little more stress on yourself because you're obviously paying to rent somewhere else or live somewhere else, and then you also have to pay extra money into this negatively geared property. The thing is, however, at the end of the financial year, the Australian Taxation Office will recognise this as a sort of loss in income, and you'll be able to claim the interest of the mortgage against the property. You'll also be able to claim any of the maintenance works, any of the bills and costs of sort of holding that property. So yes, you might end up with a nice tax return or a reduction of your tax liability come the end of financial year, but it has been a struggle to get to that point because the other 11 months of the year you've had to make up that shortfall. So I'm going to show you now just a graph of the Australian Residential Property Price Index, and this shows all the capital cities and then a weighted average. So we'll switch over now. This measures from December 2011 till December 2021. So we have a 10-year time frame here. Now, as you can see, this is showing all properties starting at 100. All major cities starting at 100 in the December 2011 month. And what you can see is the upward trend on most cities. Now, obviously, we have Perth, for example. It comes down below that that $100 line, and then it creeps back up slightly. And over a 10-year time frame, we are still shy of 20% returns in that time frame had you bought in exactly December 11. Now, I bought my first property in April of 2014. So as you can see, that would be round about this sort of time frame, March 2014. So if my average index was 114.8, come 2021 and we're only at 120, I've actually earned less than 6% returns in that time. That's if we're going off the index average. So yes, I've built wealth, but it has not been easy to do so. When the value of my property came down below that $100 mark of the index, I was at quite a significant loss of about close to 20%. So yeah, that's very stressful. Now the narrative of trying to build wealth in property, obviously, while it does come with a lot more overheads over the long term, as demand for property increases due to population growth, we can assume that the price of property should go up. This drop in the index for Perth especially was due to the, collapse of mining stability, although now it is starting to actually run again due to the resource price increase due to the pandemic that has recently occurred. So there you go. Now, if we look at the weighted average of all the capital cities, you can see that upward trend comes from that $100 mark to just over that 175. So we're looking at over a 75 to 80% increase in that 10-year period, which is actually pretty good if you ask me. Like, you're still getting a decent return, but is this the best possible return we can get? Well, it doesn't seem so. When you look at asset classes like shares, where your money does double actually every 7 to 10 years, you have no costs of overheads for holding them, and you can just reinvest your dividends every single quarter or month or 6 months whenever you receive them. Or you can take some of those dividends to live on whilst the price appreciation occurs. We can actually build our wealth a little faster. So, depending on which city that you're measuring, if we look at Sydney, that's had the most growth. Melbourne's also had some pretty phenomenal growth here, with Darwin coming in at the very bottom, so performing the absolute worst. Hobart's done quite well. When we look at all of these, over 10 years, you might be able to double your money just by having bought property in Hobart or Sydney. But this does not necessarily mean it was a pain-free experience. So there's obviously the fear that comes of managing a property. You have to insure it. You may have any damages to a fix or anything like that. Now, this does not occur with shares, and we're going to pop over now to the ASX index for the last 10 years, or for the last 20 years, sorry. So, in 2002, April, the price of the ASX was 3,350. If we look to today, so March 25th, 2022, we have 7,406. Now, this obviously is over a doubling. It's very awesome to see that this is possible, but this is in twice as long a time frame as what we just talked about with the price property index in Australia. So we're actually going to try and do this off 2012, about March, okay? So March 2012, we had a price index for the ASX 200, which is the top 200 companies listed on the Australian Stock Exchange by market cap. This was at 4,335. Move to today. Where are we? 7,406. So we still haven't even had a doubling in that 10 years. Now, whilst I do say that the average long-term returns of the stock market is around about that 8% mark, as you can see, there's been lots of times where the market's had big significant drops, and even though the share market has recovered during those times, you may find that had you been buying in peaks and then you see losses, that you have less returns than someone who's just dollar costed averaging the whole way. If, for example, you did a lump sum buy on the 31st of January while the index was at 7,017, your returns to today, being only about 500 points, to today being only about 400 points, are just not that significant, okay, compared to if every, say, month or quarter we were adding our $1,000 or however much it is you wanted to contribute as those dividends reinvest, we'd sort of average out all of the lows. Our cost basis for buying would be a lot lower, and therefore your returns may look a lot better than what you were achieving from property. The best thing, and probably the least stressful thing about owning dividend paying stocks, is you have no overheads to hold them. So you're never going to get a tenant call you up and say, hi, your share's hot water system just broke. That just doesn't happen. What also is really cool about owning your stocks in Australia that pay dividends especially, is when the company that is paying the dividend has already paid tax on your behalf at the corporate rate of 30%, you then receive a franking credit, which sort of boosts up your income a little bit, and that's what makes shares so attractive. You get the capital gains tax discount if you hold your shares or property for over 12 months, so that makes liquidation cheap and you can capitalize on some growth. You get a franking credit applied to your taxable income if your dividends have already paid that franking credit, and also you have no monthly ongoing overheads, so that reduces that stress load a lot. That's why shares are probably my favorite investment class and why I will continue to keep buying. Now, the next thing we're going to look at is the Bitcoin price index. So Bitcoin is a cryptocurrency asset. It's used more as a store of wealth than a cryptocurrency at the moment. And whilst this page is loading, sorry, I thought this was done. Whilst this page is loading, I'll just explain a bit how Bitcoin sort of came about. So a lot of people have not been trusting in the fiat currency system that governments have imposed. So when you come to look at crypto assets or cryptocurrencies as not only a place where you can store wealth, but a place where you can start to transact without fear of regulation or money being controlled. This is what attracts a lot of people to the asset class. So Bitcoin was founded by Satoshi Nakamoto back in 2009. And if you look at this price graph from when Bitcoin first started in 2009 all the way up to today, the price has been absolutely parabolic, okay? We've had a few peaks and then drops, and then the Bitcoin cycle continually repeats, and you can watch the value grow over the long term. Bitcoin for the last 10 years was the best performing asset class, and Bitcoin makes up half of the cryptocurrency market cap. So as you can see, there has been an absolutely insane sort of growth pattern on cryptocurrency. And looking at this graph from 2014 all the way to 2022, had you started with that price for your Bitcoin being $723, and today it would be worth $42,233, that would have been such a phenomenal return on your money that you could literally, with a very small initial investment, be at the age where you could retire today. So that's what's so attractive about cryptocurrencies, and as more people sort of start to adopt it, its utility grows and it becomes more mainstream for a method of transacting, then cryptocurrency will continually pull more money into its market cap. Now, this doesn't just mean Bitcoin, but also other big utility coins such as Ethereum, Cardano. They are likely to also see a good price appreciation. So that's what makes cryptocurrency a very, I guess, attractive asset class, and why it's worth having some in your portfolio if you're looking to diversify. Although, understand that crypto does come with a little more risk behind it. So there you go. Those are the three main investments that I would focus on if I was looking to build some real wealth. I personally dollar cost average into shares and cryptocurrency every single month. And I do actually have some investment properties where I can utilize my rental income to then invest into other asset classes. So there you go. I would recommend that everybody researches this. Make sure you completely understand an investment before you purchase, and only invest as much money as you are willing to lose. As always, stay safe out there. And if you got any value from this video, please like, share and subscribe. I really look forward to seeing you in the next video.